A challenging, wonky year. Does distress loom in Phoenix multifamily market? Apartment market conditions continue to weaken amid worsening financial conditions nationwide. But Phoenix and other Sunbelt markets that saw the most multifamily construction in 2023 are now beginning to see those units delivered, which is going to create a softening in those markets. It's still going to be a challenging, wonky year this year. What we're seeing right now in Phoenix and in other places such as Texas and Florida, there's certainly going to be some downward pressure on rents as new supply is being delivered. I think while we are seeing a short-term softening, it's been really challenging for developers to get new projects capitalized. If you're a developer and you don't have your own equity together and you're out looking for equity today, it's very, very challenging. That's exactly how Scottsdale-based Empire Group has been able to continue to develop thousands of rental units in Metro Phoenix as other developers and apartment buyers remain on the sidelines. We have a fairly large network of financial advisors whose underlying investors provide us with capital, said Randy Grudzinski, partner and head of capital markets for Empire Group. Peter O'Neill, research director for Northmark, said he wouldn't even call the local market stressed. I'd say we're more in a wait-and-see mode rather than stressed or distressed, O'Neill said. Rental occupancy in Metro Phoenix was 92.8% in the first quarter of 2024, down from 93.6% during the year-earlier quarter, according to O'Neill's latest research. There were 10 multifamily properties sold for $595 million during the quarter, compared to 13 sales for $753 million during the Q1 2023, he said. The median price per unit actually increased to $324,700 during the Q1 2024, from $233,700 in the year-earlier period. However, about half of all the properties that have traded so far this year have been Class A properties, many which just finished construction within the last year or two, he said. These types of properties usually are sold at the highest per unit price. For example, the Scottsdale Grand, a 285-unit apartment community built in 2020 at 15501 North Dial Boulevard, closed for $117 million on May 1st. The seller, an entity tracing to Oxford Properties Group, had previously paid $130 million to Kaplankas for the asset in July 2021, according to Vista. In comparison, more than half of the properties that sold in the first quarter of 2023 were Class B buildings, generally properties that were built in the 1980s, with a few in the 1970s and 1990s sprinkled in, O'Neill said. If we were comparing apples to apples, we would probably see that prices are down about 15 to 30% from the peak, which occurred in 2022. Higher mortgage rates have slowed transaction activity, O'Neill said. It's tougher to underwrite acquisitions when the borrowing costs are going higher, especially when the expectation was that they would decline, he said. The latest economic data is another signal that we shouldn't expect rate cuts from the Fed anytime soon. The first quarter was stronger from an absorption, rent and vacancy perspective than O'Neill expected. But we're still forecasting softer conditions by the end of the year, he said. Vacancies are almost certainly going to push higher as more units come online, and the increasingly competitive market will likely result in rent declines. Year over year, April apartment rents were down 3.9% in Metro Phoenix, according to activity on the Apartment List platform. This offers a bit of a reprieve for renters who are beginning to see more move-in specials at a time when home prices are back on the rise, according to the S&P CoreLogic Case-Shiller indices released April 30th.